Hello, hi guys, welcome. In today's video, we will talk about two very popular long-term investing tools in India, that is the National Pension Scheme and the Public Provident Fund. So both these instruments or schemes are very popular among long-term investors, and in this video, we will see the difference between these two and help you decide on which uh, scheme you should invest for your retirement corpus or for your long-term investment goals. We will also do a comparative analysis of the returns of both PPF and NPS later in the video, and I will also give you a link where you can do the comparison of both in terms of returns based on your investment duration and also adjust the returns as per your targets. So that would be pretty helpful. So we will straight jump into the uh, to see what these schemes are about. So firstly, the National Pension Scheme. So National Pension Scheme was initially started by the government. I think it was around 2004 when they opened this for government employees, and they made it mandatory for government employees to put a part of their uh, earnings every month into the national pension scheme. So do keep in mind, national pension scheme is not the same as employee provident fund, the EPF. So that is a different one. So EPF is also a long-term investment tool, but it is not a retirement tool to be specific. So NPS is specifically designed for your retirement, and post your retirement you will be able to get a lump sum amount, and also and a part of the amount will be moved into an annuity where you will get monthly pensions depending on the corpus which you have got over the period of your investment cycle. So the so this scheme is run by PFRDA. So this is the regulatory authority uh, which runs the scheme, and it is a government authority. So it is managed by different people, but like HDFC, LIC, etc. But the authority is PFRDA, and it helps you build a retirement corpus in a systematic manner. So on retirement in the scheme, you will be able to withdraw about 60% of your corpus as lump sum, and the remaining 40% will go as annuity. So I'll explain that annuity part a bit later. So as I told, this was started for government employees in 2004, but the government opened this scheme up for everyone in 2008. However, it's only mandatory it's for government employees to invest in this scheme. However, for private employees, it is an optional. Unlike EPF, where you don't have an option, you have to invest if you are working, but NPS is completely optional for private employees. Coming to PPF. So PPF is again an optional scheme. You don't have to compulsorily invest on it, but it is a saving cum tax saving instrument in India, aiming to mobilize small savings by offering an investment with reasonable returns combined with income tax benefits. So you have huge income tax benefits in PPF, and also you have a fixed interest rate in PPF, which is higher than your bank FDs. So in NPS, your returns are linked with the markets. That is, it is a market link scheme. Depending on the performance of equity market, bond market, etc., your returns will vary. But in PPF, your returns are fixed, and it is fixed for a duration. I think the government fixes for a duration of maybe 6 months or 1 year. So currently, the rate of interest is 7.1%. However, it may increase or decrease over a period of time. However, with NPS, it is different. It depends on the performance of the bond and equity markets. So coming to, let's move into the parameters. on which the NPS and PPF vary. So first, the investment objectives. So the investment objective of NPS is to invest in securities keeping in mind very long-term retirement planning. So NPS is designed specifically for retirement, while PPF is designed as a long-term investment tool, but you can remove this after 15 years tenure. So if you're 30 years or 25 years old, when you become 40, 45, you can remove this investment, and then you can look for alternative investments. But NPS, you have to wait till your retirement age of 60. Who can invest? Any individual can invest within this age bracket, 18 to 60. With PPF, any individual, even a minor, can open a PPF account with a nominee as a major. So fund managers, pension fund managers approved by the government of India. So these fund managers include SBI, LIC of India, HDFC, etc. In this PPF, the complete fund is managed by the central government. Rate of return is not fixed. As I told, NPS has is a market linked product, so the returns may vary. So as of now, these most of these funds are giving 11% returns in the last 10-12 years. So this may increase or decrease depending on the performance of the fund and the market. PPF, so this data is old. So as of now, this is 7.1% because the interest rates have come down drastically in the post-COVID world. So it is, but still it is comparatively higher to your bank fixed deposit. So minimum investment is this is 6,000 per year, that is 500 per month. Here it is 500 per year. The lock-in period is until you turn 60 years. Here you can remove after 15 years. So this is not 60 years. This is when you turn 60 years, you can remove the investment. Here it is 15 years from the day you start investing. Maximum tax deductible for income is around 2 lakh, and here also it is 1.5 lakh. I think it's a typo here. It's 1.5 lakhs. On maturity, you will get 60% return, and 40% of the compulsory investment you have to take an annuity product. So if I'll explain what is an annuity. So if your corpus is 1 crore during retirement, so 60 lakh you can remove, right? So you will be left with the remaining 40 lakhs will be converted into an annuity, which will be divided into monthly installments, and you will get something like, for example, every month 25,000 you will receive until you turn 80 or 85 or until your death. So it all depends on the investment corpus. So 60% lump sum you can remove. The remaining 40% will be converted into monthly investment installments, and it will be given back to you monthly as pension. So that's why it's called the National Pension Scheme. Uh, with PPF, obviously you can remove 100% directly after the 15 years of investment. You can remove the complete investment. With both, you can exit prematurely, but there are like lot of conditions and there are distractions, but I would not but I would suggest you to not do that, because then the whole purpose of the investment doesn't get satisfied, right? Next, let us move into the various criterion. Safety in PPF is pretty high because it is run by the central government. The NPS is lower compared to PPF because it is run by fund managers, but it is still governed by authorities. Similarly, like equity markets are governed by SEBI, this is governed by PFRDA. So returns in PPF are moderate because you earn only an interest of 7.11%. NPS can be high. As of now, it is around 11-12%, but depending on the market performance, it can go even till 13-14% or come down till 8-9%. I think NPS will traditionally has given traditionally higher returns, so you can expect the same, but this gives more stability. Liquidity in PPF is low, and NPS is also low because this is not like equity markets where a lot of trading takes place. So there's only a like small amount of working people who invest in these instruments. I mean small compared to the normal equity bond markets, but still it's a big number in India if you see the working class. So taxation, there's very low taxation on NPS. I'll explain that in a different video where I'll cover all the facts about NPS. So do subscribe to the channel. I'll make a new video on national pension scheme separately and PPF separately, and I'll show you how to invest on this. So again, PPF is fully exempted from taxation. Let's come to the calculator. So I've made this calculation um, where I have shown the returns of both if you invest for 30 years each. So as I so told, PPF you can remove after 15 years, but considering you continue and invest for 30 years, and similarly NPS, I've assumed your age is around 30 and you will invest till 60 years till you retire. So I've done to keep the comparison same. I've taken 30 years. So in PPF, if you invest 30 years, into an yearly investment of 60,000, that is 5,000 per month, at a rate of current rate of interest of 7.1%. On retirement, that is at 60 years, you will have a maturity value of 61 lakhs, right? The same calculation I did with PPF. With PPF, as I told, you can't remove the complete 100%, right? There's only 60% you can remove, and remaining you have to convert into annuity. And here I have kept the expected rate of return in NPS higher because it's a market linked one. Obviously, there are high chances that it will be around 10-11%. So if I do the same investment, that is 60,000 per year and 5,000 per month, then I will have n month at the end of 30 years. I will have a corpus of 68 lakh 37,000. Here it was 61 lakh. Plus in NPS, I will have a monthly pension again of 22,793. I'll get extra till I turn 80 or till my death. So obviously, if you see for the same investment, NPS gives higher returns. But obviously there are other factors like the lock-in period, etc. So if you're just looking at a 10-15 year horizon, then PPF is a good option. But if you are investing till your retirement and specifically looking to have a large corpus and also a pension at retirement, then NPS is the go-to scheme. So thanks a lot for watching this video. I'll make another video specifically for NPS and PPF and show you how to invest and how to calculate all the returns.